It's great to see so many people here today. We have 926 attendees as of 7 o'clock this morning, so welcome everybody. So in many ways, our keynote speaker today gave birth to this industry. While it's true Lending Club was not the first platform to launch, they were the first platform to achieve scale in this industry, to achieve a large scale. And Renaud and his team also helped formulate the regulations through which this industry operates today. And through that, they have built Lending Club into what is one of the most valuable private VC-backed companies in the world. And one of the interesting things that I think is that the vision that Renaud had back in 2006 when he was coming up with the ideas for Lending Club, that business model that he came up with in 2006 is pretty much intact today. And at LendIt last year, Renaud gave us a great presentation about transforming the banking system. Today, he's going to expand on that presentation and show us how Lending Club and the industry is going to partner with the banks in this transformation. So I'm excited to hear his presentation, and so without any further ado, please join me in welcoming the CEO and founder of Lending Club, Renaud Laplanche.
Good morning. It's great to be back. So yes, last year we talked a lot about how we as an industry are already planning to transform the banking system, make it more cost efficient, more transparent, and more consumer friendly, but really associate the banks to that transformation. This year we're going to expand on that theme and really see how far we can take it and how that fits into broader industry trends, broader internet trends, and really how, at the end of the day, we want consumers to benefit from the transformation. So I think to look at trends, really, we need to look at what happened before the trend started. And so if you remember life before the internet, let's go back to the 70s, for example. In the 70s, really, businesses used to create value by doing three things. Really, first one was vertical integration. The second was reaching scale, and the third one was sort of raising awareness and building a brand through a lot of mass marketing. Really, these three axes of development didn't create a lot of value for consumers. So consumers, as a result, had poor value exchange, limited choice, and limited information. Over the last 30, 40 years or so, really the technology revolution has powered a lot of progress that benefited consumers in many ways. One way was by reducing cost, and the cost of a telephone call today between Los Angeles and New York is about 90 times cheaper than it used to be in the 70s. It also benefited consumers through convenience, and the size of a computer is about 100 times smaller today. By the way, the computing power has increased by more than 100-fold in the same period of time. The technology also helped make more information available, and even before bringing up the internet, just the number of TV channels available went from 5 in the 70s to over 200 in the average sort of cable program today. So you knew this was coming. In the same time, the banking industry really hasn't seen as much technology improvement, as much efficiency gain, whether it's gains that benefit the banks or benefit their customer base. And really, if you look at that measure of efficiency, which is sort of revenue derived from as a percentage of intermediated assets, there's been really no efficiency gain since the 1900s in banking. And then when you look at the value really provided to consumers, you see even less value capture, and the spread between the borrowing rate and the savings rate, which is a value that's not captured by consumers, actually increased quite a bit over the last 30 to 40 years. And then the banking industry became even more concentrated. So there was less efficiency, less choice available to consumers. The top 10 banks in the 1970s represented about 20% of total deposits in the US. Now that number is over 50%. So more concentration, also less differentiation. This is a study realized performed by Oliver Wyman, but really a sort of value perception study going out to 3,000 customers and asking them to rank along two axes, quality and value, their perception of different brands. And if you look at a sector like retail grocery stores, you see a clear map and clear value differentiation with Whole Foods having a very different positioning than Costco. The same question asked about the banking industry returned much less differentiation. And so not only there are less banks and the banking industry is more concentrated, but there's really not a lot of, the difference between these banks is not perceived by consumers. And certainly it doesn't help that banks even look the same today than they looked in the 1900s. So this is a picture of a bank in the 1900s. This is a picture of a bank today. So the internet came in and really changed a lot of things. And there were really four waves of innovation through the internet. The first one was online storefronts. So really doing the same thing we used to do offline, doing it online, but bringing it online really helped reduce infrastructure costs and helped lower the costs. And then marketplaces came along. First in the travel industry, and websites like Expedia, Orbitz, Travelocity really helped compare and provide more choices and more information to consumers. And the third wave was really about many-to-many marketplaces, and companies like eBay really was the first to reach scale that helped sort of further provide choices to consumers and really bring items that you couldn't buy outside of these many-to-many marketplaces, and we'll have a few examples later. Then the fourth wave, which is really more recent and developed over the last few years, is really the sharing economy, and we're going to talk about that as well. So in the same period of time, really the number of internet users grew very quickly from about 20% of the US population in the 2000s to 70% today. And all these successive waves really brought in more cost efficiency, more information, more choices for consumers. So there are a few examples of this happening in financial services, not so much in banking, but for example, in stock brokerage, the cost of a single stock trade on Schwab went to $130 offline to really to $20 online, and now a lot less as that trend has continued. Marketplaces also exist in the financial world, and here you have an example of the sort of UK car insurance origination market, where that market went from being 10% online to 60% online, really as a proof point that these marketplaces help provide more choices for consumers, better information, and make it easier to transact online. So we talked about eBay as a first many-to-many marketplace to reach scale. There's been a lot more since with StubHub and Etsy and CafePress. But really, eBay was the first to bring that notion of making items available online that were not available offline, and that's the very founding of eBay was this broken laser pointer that PR Media sold on the website. And many-to-many marketplaces brought more choices, continue to lower cost, and generate efficient pricing through a pricing discovery, in the case of eBay, through dynamic pricing. And then what really happened over the last few years is the rise of sharing. We as a society became more comfortable sharing information. And so Facebook obviously grew extremely fast by 1,000-fold over the last less than 10 years. Twitter built up on the same theme, and with 500 million tweets exchange every day now. And YouTube really took that a step further with our ability to share videos online. And there are now 100 hours of video being uploaded into YouTube every single minute. And most of these videos really are about your cat. So if you do a search on YouTube, on the term cat, you return 32 million hits, which is absolutely amazing. So 32 million is more than the total number of websites available in 2001. And it's about 100 times the total cinematographic production in the world. So you can now post pictures of your cat on Facebook, talk about your cat on Twitter, and more importantly, really upload videos of your cat on YouTube. So for good or bad, we became more available with sharing. In the financial services, the idea of sharing got a slower start. There are a number of reasons not to share, privacy being one of them, but this also is changing, and financial websites that let you share financial information really are growing faster now than some of the largest social networks, obviously starting from a smaller base. With companies like Venmo that lets you make payments online and really share the purpose of your payment with your friends. So an interesting trend there. The other trend really that completed this picture is what happened in 2008. I think 2008 certainly repriced financial assets. It also repriced happiness and what really a lot of people are looking for. This is a sort of search index excerpt of Google that shows a number of searches relative to other search terms on Google, and you can see that the number of searches on the term happiness increased more than twofold around the financial crisis and stayed very high. And really, I think when we look back, we'll find that the financial crisis of 2008 was really the starting point of the decline of consumerism and overconsumption, and our collective focus on buying more stuff, and really is a starting point of sort of new business models, new even media, new ways to talk about the world with companies like Upworthy or Polycemic that take an entirely different take on news and information and what it means to inform consumers, and really the beginning of a lot of us being more focused on using the assets we already have, putting them to good use, and sharing with others. And that really paves the way for the sharing economy. That's really born out of these two desires of, certainly one is financial, and a lot of people got into hardship in 2008, and sharing their assets and putting them to good use and charging for it was a way to improve their financial situation. But there's definitely a social and societal aspect of it, and really the desire of sharing what we have and making connections this way. And so you saw the emergence of a number of companies, a number of business models that did not exist 5 years ago, with companies helping us think differently about the extra desk in our office space, or the car in our garage that we're not using all day, or the extra savings on our bank account that we could put to better use by lending it to other people, and a number of other business models that are becoming more and more pervasive, and which adoption is rising very quickly, with a lot of new models being created every day. I saw last week a company called Spot On that really lets you share your driveway and let people drive their car into your driveway when you're not using it. So a number of business models emerging and really getting fast adoption. And so, as Peter mentioned, ironically, in a way, many of these companies that are helping us share are becoming some of the highest valuations among private companies, and 3, in fact, of the top 8 highest value companies, Airbnb, Lending Club, and Uber, are already part of the sharing economy. So we believe that what we do at our industry is really the convergence of these internet trends and what happened and did not happen in banking over the last several decades. And we're calling this marketplace lending. It's actually a new term, and we've been using very different terms for our industry, from social lending to peer-to-peer lending to the marketplace lending. It's actually a term coined by Charles Moldo and Foundation Capital in a new white paper they have released this morning that's on their website at foundationcap.com, which is, I think, one of the most comprehensive and best white paper about the industry. And they coined this phrase marketplace lending, which I think is a good descriptor for what we do. With a very wide variety of companies, some using a pure marketplace model and others using more of a hybrid approach and partly using their balance sheet and partly using a marketplace model. But back to sort of marketplace lending and how it fits into internet trends, we're really, I think, as an industry benefiting from all four trends that we talked about. The online storefront trend that really enabled a lot of cost savings. So there are many ways why we are operating at a lower cost than the banks. One of them is because we are online and we save on about 200 basis points as a percentage of assets of the cost of running a branch network. The second wave and second consumer benefit really is what comes with marketplace is a lot more information and transparent information. And Lending Club and many marketplaces in our industry really make all their data available online. You can download every single loan that has ever been made by Lending Club since inception. And also we facilitate really transactions in a way that's more convenient for the user than driving to a branch. The third wave really about sort of many marketplaces build up on the same themes but expand them and continue to further sort of lower intermediation cost and more choices for consumers and make the intermediary in the middle smaller and allow the intermediary to operate at a lower cost. And really the fourth trend around sort of the sharing economy is again about this desire to put really to put assets to good use, assets that you're not using, and in the case of marketplace lending, that asset is really money. And there's a lot of us having sort of savings in our bank account that's earning less than 1% interest rate, and the idea of putting that money to work and helping someone along the way and earning an interest rate is really an important trend into the development of this industry. And there's also a social aspect of it, and a lot of our borrowers telling us that all else being equal, if they come to Lending Club because we have lower interest rates and we're more convenient than the alternative, but all else being equal, they tell us that really they love the idea of paying interest to someone like them as opposed to paying interest to a big financial institution. So really all this gave birth to what we believe is going to be a very large industry that's going to be here to stay, that's going to have a profound impact on the banking system, and is becoming increasingly diverse and is starting to touch a number of industries and a number of, I should say, credit products. So it started with consumer lending and then small business lending, and a number of other types of credit products are now available. This particular chart is an excerpt of from the Foundation Capital white paper. That industry also became really a global phenomenon. And so this chart was produced by our friends at Liberum, and it shows also the sort of diversity of the industry, the global nature of it, and how it became a global phenomenon. The phenomenon that's experiencing a very rapid growth with an annual growth rate of over 100%, with the 5 largest marketplaces in the world having issued less than $1 billion in 2012 and over $3 billion last year. So we are happy to lead the way and continue our fast, deliberate, and responsible growth. So we issued close to $800 million in loans just in the last quarter. With our organic growth rate and the acquisition of Springstone, it's not hard to imagine a $1 billion quarter coming up soon. And really, I mean, the 3 reasons why we're growing so fast. I mean, one is certainly lower cost. We showed this slide before. It really explains how we get to a lower operating cost than the banks. And really, there's a cost saving of more than 400 basis points, again, via the traditional banking system. A very important aspect is not only we operate at a lower cost and can deliver more value for consumers, but we also deliver a better experience, an experience that's fully online, and that's using technology, not just to lower cost, but to improve user experience. This chart shows the Net Promoter Score, which is really a measure of how likely our customers are to recommend our services or products to their friends and colleagues. The banking industry has historically not generated a lot of customer satisfaction. So since 2008, that did not improve. And the community banks and credit unions have done a better job than the large national banks delivering a good experience. But Lending Club with a 79% net promoter score is way out there and really leading the way. We're also leading the way in terms of transparency. Not only you can download every single loan ever made on the platform, but you can also look at the return and the variability of return for every single investor who invested on the platform. And we believe that's really one of the premise of the internet and of marketplaces to really deliver that kind of transparency, and we're believing we're delivering on it. So where we're going from there, our goal is really to sort of transform the banking system and not stop where we are today, but we've expanded quite a bit our product offering over the last quarter, really, and released a small business lending platform that's helping small business owners access the same kind of responsible, affordable credit that consumers have been accessing on the platform. And we acquired just a couple of weeks ago a company called Springstone that provides tuition financing and patient financing, so essentially financing elective medical procedures and helping parents sort of pay for kids' education or get braces or for their kids or implants at the doctor's office. So this is just two examples of the things we're going to be doing in the future. We believe we will expand from there in no particular order to help our customers in other parts of their life and help them buy a house, buy a new car, help our business owners buy some new equipment, or get a new office space, again, in no particular order. So one of the ways we've been expanding over the last year to 18 months is really by sort of partnering with the banks. We want to transform the banking industry, but we associate the banks to that transformation. And we announced here at LendIt last year our first partnerships with two community banks, Congressional Bank and Titan Bank. We've been sort of continuing to work with community banks and have a number of them now active on our platform. And really the way it works is not only the banks have an opportunity to invest in the loans that we originate, but we also sort of look at the banks as partners and combine with other investors we let the banks contribute their customer base, contribute their low cost of capital, and really use the online experience that we deliver to these customers and our low operating cost. So when you have a low cost of capital, which is really one of the attributes of the banks, and a low cost of operations for Lending Club, you really get to the best possible outcome for consumers and generate a lower cost of credit and a great experience. So today we are expanding on that notion of working with the banks. We had been working so far with relatively small banks that were the early adopters on that trend. Today we are really happy and proud to announce a new partner, which is one of the sort of larger banks, and that's Union Bank. So we're announcing today a wide-ranging partnership with Union Bank, whereby we will be sort of developing products jointly and offering these products to both customer base and sort of offering in particular sort of unsecured consumer credit to Union Bank's 1 million customers. So Union Bank is one of the top 20 banks in the country. It's a stress test bank. They have about $100 billion in assets, and they're one of among the largest banks in the country. They're really one of the sort of early adopters, one of the banks that are the most focused on innovation and on bringing sort of great experience and great product to their customers. And we are very happy to announce this partnership today. So that's all I had. I think we have 5 minutes left, and we can take some questions.
So if you have a question for Renaud, you hold up your hand and stand up. Okay, right here. And actually, why don't you, we have a microphone, so let's just wait till the microphone gets here and then everyone will be able to hear you.
Hi, it's Corey Leach, Liberum. Can I be slightly cheeky and ask you about the IPO and what the timing and the likely valuation range will be?
I almost said it. I said, you can ask me any question you want except for the timing of an IPO.
No surprise.
Yeah. I really can't answer that question. Any other question?
Yep. So, just wait. Can you wait for the microphone so everyone can hear you?
Thank you. So very interesting announcement about your partnership with Union Bank. Can you talk a little bit more about where you see the industry going, if you see partnerships like that happening?
Yeah, we hope so. I mean, I think the banking industry is very diverse. There are over sort of 6,000 banks in this country, and many of them currently and certainly in the future are going to partner with our industry, and they can partner in many different ways. I mean, there are some of the largest banks that provide financing for some of our investors and some other platforms, and there are community banks that really have a strong desire to benefit from the ability of this industry to acquire customers online, originate loans, underwrite, price, and service loans at a fraction of the cost that these banks could do. So again, I really think the combination of the banks' large customer base, trusted relationship with their customers, and low cost of capital. The combination of that with this industry's low cost of operation and ability to deliver a great service online, that creates the best possible combination for consumers. And so at the end of the day, that's what we want. We want consumers to have access to affordable, responsible credit. And I think the perfect combination of that is people in this room and this industry really sort of combining forces with the banks.
Okay, just here, wait for the microphone. Where did our microphone runner go?
Can I go now, then, while he's waiting for the microphone? Okay. We speak a lot about the investment dollars coming into the platforms and such, but one of the biggest challenges talking with dozens and dozens of people on a weekly basis is it's still relatively unknown at the consumer level with peer-to-peer lending. Can you speak to how the industry approaches becoming those advocates out there to the industry and how we convince others that this is a reliable and manageable investment for them?
Well, I think actually seeing that banks participate in this asset class is another credibility enhancer. And I think this industry started with retail investors, individual investors, and the expansion of the retail base continues to happen quickly. Then the larger institutional investors came in and also is also a funding source that's growing pretty quickly for us and for the rest of the industry. I think that in itself is validating because the professional investors have more tools, more analytics, capabilities, and more data. So that's a good way to validate the model for retail investors. And certainly the banks that are really in the business of making loans to consumers now are investing on the platform. So that's another way to validate the asset class. Validate it not just from the standpoint of pricing and underwriting and expected loss rate, but also from a compliance standpoint. Many of these banks have a very high compliance standard. I think their ability and their stamp of approval from a standpoint of compliance is validating for retail investors.
Okay, last question. Doug, do you want to do a question? Who we got?
Sorry, Stuart Law, Assets Capital.
Sorry, we're up. Okay.
Yeah. So the question is whether we're thinking of going international. The answer is yes, but there's no particular timing. I think really the size of the U.S. consumer credit and U.S. small business credit industry is such that there's really no urgency for us to do anything else, and we believe that focusing on the domestic market is a better use of resources right now. And so others are doing a great job internationally, and I think at some point we'll redirect our attention to international expansion, but that's probably not something we'll be doing in the next 2 to 3 years.
Okay, last question from the back there.
Stuart Law, Assets Capital, UK. We've seen the first phase of retail investors funding peer-to-peer. Then we've moved to institutions. Do you think the move to banks with their lower cost of capital is going to see a third phase and squeezing institutions now as opposed to retail?
Yeah, so I'm hoping we can manage the expansion in a way that doesn't squeeze anybody out. And I think what we've done with institutional investors is a good example of that. Certainly, sort of retail investors feel that institutional investors are crowding the market out. I can tell you institutional investors feel the same way about retail investors. So I think that tells us we've done a pretty good job at maintaining a balance and at really setting rules of the games that are fair to everyone and really leave room to everyone. So the good news is that the industry is growing very quickly. Lending Club, it's growing origination as quickly as we feel is responsible. So that creates additional room. So the entrance of the banks really wouldn't come at the expense of other funding sources, but of our customers, but really as an additional funding source. And keep in mind that the partnership with the banks is not just banks investing on the platform. It's also us partnering with banks to provide consumer credit to their customers and really sort of expand their customer base and expand their penetration within their customer base that way. So it really plays on both sides of the platform and will help us continue to bring more consumers, more credit-worthy consumers to the platform. So we believe everybody will, all types of investors will benefit really from the banks being involved.
Great. Thank you very much.
Great, thank you.